Hi, Steve Sosnick here with today's Interactive Brokers Midday Market Update for Friday, June 5th, 2020. Um, Not much to say that hasn't been said already today. What a day we're having. The economic numbers were truly a surprise. I mean, when you have a number that, a positive jobs number that is so outside of consensus, you could do one of two things. You can doubt its veracity or look for quirks, which I still think there may be some that we haven't seen. Or you could just sort of decide that this is a great thing and we love positive surprises, and that's clearly the tack the market's taken. Look, I mean, I've been sort of down on the market a while. I've not suggested that people go short the market because the tape is just too strong. Although right now, I'm still in a state of disbelief. It was interesting because watching this morning, I'm like, wondering what am I thinking? And they did an interview on Bloomberg TV with Mohammed El-Arian, and he and I think sort of share the same opinion, which is, he said if he was still managing money, he'd be very torn because he doesn't really quite get the valuations. I'm paraphrasing, of course. And so in his personal account, he's staying relatively short, and he's kind of counseling a wait and see. I'm of the wait and see mode. Let me put a couple of things in perspective for you. Markets, yes, should be discounting future results, and I do believe that markets look, 6 months to a year, 3 to 6 months to a year into the future. Depends how far. Okay. Right now, the S&P 500 is 1% below where it was at the end of last year. The NASDAQ 100 is 9% above where it was the end of last year. So are we discounting a corporate earnings environment that's better than the market was discounting at the end of last year, when everything was rosy, when we could see into the future and it looked great, where no one had heard the term coronavirus, and you lay all that out and say, okay, well, what's different? Well, there is something different. It's monetary and fiscal stimulus. But now the other question you get into is, and I've already started to see some rumblings from let's say certain economists that perhaps we don't need to do any more fiscal stimulus because things are already turning around so fast, and that perhaps and the shape of the yield curve is telling you that that while it is steepening, which tells you that the bond market's pricing in economic recovery, the short end of the curve is also moving up. It's not a parallel shift, but sort of the long end of the curve is moving up in terms of yield, moving up faster than the short end. The bond market may be starting to tell you that the Fed's going to take their foot off the accelerator. And actually, some of the numbers that were released last night are, yet again, the Fed balance sheet is expanding, but not at the rate it has been. And so you got to ask yourself now, are you playing along with the trend, which is, of course, a very powerful thing if you're a trader, or are you a value investor and saying, how much of this value, where is this value coming from? And this becomes a real conundrum. I don't really mean to be throwing a dash of cold water on a day like today. It's an up day, and I can't imagine, barring some incredibly weird event, that it would be anything but a massively higher move, more or less across the board. We're actually almost seeing the rare 10-to-1, 9-to-1, 10-to-1 up day, which is quite remarkable. On a 9-to-1 or a 10-to-1 down day, that usually means a selling climax. I don't really know what it means on an up day because they don't really happen all that often. So I'm not going to say that that's a buying climax. But going forward, I think we're going to have to see some more analysis as to how the economists get this so wrong. Is there some sort of quirk that they all missed, or is there some sort of way they count the numbers that was unanticipated? Maybe. The trend remains higher. The valuations remain stretched. How that plays out over the long term is really the $1 million question for the markets. As of now, my gut still tells me, as a value investor at heart, as a trader, I follow the trends. As an investor, I'm a value person. And from a valuation point of view, boy am I worried that we are pricing in not only a complete recovery over the next 3 to 6 months, but well into the future. Bear in mind, the unemployment rate is still 13%, and that while the employment numbers look good, you're coming off a really bad base, and so bear in mind that's really the question that investors have to wrestle with. Are you an investor? Are you a trader? If you're a trader right now, you could argue maybe we're a little overbought, but clearly the trend has been to the upside. Traders think that way. Investors have to think a different way, and this will be the theme clearly for the weeks to come. Have a good weekend, everybody. Bye-bye.